Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929, our telephone number. Write down the number. Get your questions ready and give us a call after the show so that we can help you answer those questions you're going to need to answer because you want to buy that house. You want to sell that house. You want to get a refi. You want to get in on the lowest rates that there have been in a long, long time. We're going to go through some of the rates and what they are this week, but trending over the last 3 to 6 months has been extremely low, almost comparison to what it was back in 2013, 2012. And the smoking rates that are available today are only going to help you more if you're looking to buy a house. Obviously, the lower rates, the more your dollar gets stretched. And you're going to need that dollar stretching, by the way, because in some of the reports that we've been reading about and looking into over the past, 3 months, 90 days, as well as this past week, real estate has really changed, the landscape of real estate from a year ago. And as we've talked about in previous shows, last week in particular, the real estate market in today's world in San Bernardino and Riverside, I want to say hi to all those great people out there, KMET, KCAA, and of course K-Tahoe, all the people in the IE and up in Lake Tahoe and Reno areas. I want to say hi and thank you very much for listening to each and every week. The real estate market and what has happened. I thought personally, we would see an expanding inventory, i.e. last year, which is 2019, actually is. Daryl, imagine that 2019's gone already?
It is such a fast pace.
It's amazing. It really is. And for those people, the demographics, people that listen to the show, they're all over the board. But when you get older, as I am, when a year goes by in a blink of an eye, I am telling you, that is a fast year. And this year was that.
Oh, I'm telling you.
Yeah, and okay, so let's get back to the story of real estate and what is happening in the marketplace in those places that we broadcast the show each and every week. Okay, we thought at the beginning of the year we would see an expansion of inventory. The reason being is because the interest rates would go up. And because of the interest rates going up, that we would see less people out there buying, i.e. the inventory would then go up, i.e. the prices would remain steady or perhaps even come down. And it was coming true. It was coming to fruition that those things were trending that way until we hit about May or June. Now, politically, the president has been hammering the Fed chief for, it has to be 18 months. And when this guy hammers you, you don't sleep that night, okay? It's just kind of the way he is. I've been watching him do this to all kinds of people, whether it be foreign leaders or business leaders. It doesn't really matter. But the pressure that is exerted by the President of the United States when he focuses negatively on you is to basically, flinch. So Jerome Powell and the Fed, and now, obviously, he's not the only one, but he leads the Fed, and there are 9 board governors that lead the interest rates up or down or remain the same. So 3 times this year, starting in about May, we saw the Fed funds rate, the overnight rate they charge to member banks, drop. And what does that mean for you? It means your credit cards are going to be a little less expensive, your car payment's going to be a little less expensive. But the sentiment in the market, and we always say that the Fed rate is not connected to the mortgage rate, but there is a symbiosis between them. If you track the way the Fed rate is, you're going to see a corresponding interest rate in the mortgage that goes up or down depending on what the Fed does, just the way it is. So when that happened, what we saw was the mortgage interest rates fell. We were trending to 4.5%, almost to 5% in some of these conventional lenders around town and around the country. The big 5, Citibank, Chase, what are some of the other ones? Bank of America, there's 2 or 3 others, right? So the big big box banks down at the corner, they all followed suit. the overnight interest rate for them dropped. And, of course, the mortgage interest rates dropped. So when that happened, the scenario of mortgage interest rates rising and inventory expanding and prices stabilizing went out the window. So we have now in December of 2019 the same scenario we had 2.5 years ago. And what is that? It's that the real estate prices are going up. Here it is. CAR on California November housing. Sales up 5.6% year over year. Inventory down 22%. 22%. So if you had 100 homes on the market last year, guess what? You got 75 on the market this year. Now, what does that do to your average buyer who's out there right now scrambling to buy a house, thinking incorrectly, apparently, that this time of year everybody's falling asleep and nobody's paying attention, and maybe you get that great deal because the seller needs to sell now? Well, according to these figures and according to the articles I'm reading, the market is actually doing tremendously, and the inventory has shrunk, which means that the prices are going up. So thank the you-know-what that the interest rates are low enough so that you can continue to be competitive in a marketplace which is filled with buyers. It's astounding. And that particular term I'm going to use, I'm going to look to the next article I've been reading about home builders. Now, new home building, is at the core of most construction jobs in the country. Certainly in the Inland Empire, and up to 15, down to 215, down to 10. Seeing new home construction is one of the greatest things that I see when I travel up and down those highways, and I do a lot. What we've seen this year is, again, an astounding thing. What we've seen, and I'll read this too, home building defies expectations, up 11% from 2018. This is new home building. Now, these companies are not stupid. Lennar or Shea or KB or you name the home builders in Southern California. And this obviously extends into Southern Nevada and Northern Arizona. We're all in this same home building spurt. When we see that kind of rise in home building, and we see the kind of pressure that they have on housing inventory in general because the inventory is down, this tells us that big companies are betting on the economy. Forget the impeachment. Nobody cares about that in business. What we do care about is, can we predict for the next 18 months to 24 months that employment will be steady and rising, that income will be steady and rising, and that housing inventories will be steady and rising? I could say a resounding yes right now to all three of those things, regardless of what happens politically. And the reason I say that is because everybody else is saying it. I'm looking at some of the economic news out there, and I'm really encouraged by the fact that what we have is low inflation, high employment, a stock market that is, setting records daily. Now, I know there are many people in the audience out there who don't own any stock. But doesn't it make you feel a little bit better about your own life if you're knowing that the financial institutions that buy stocks are convinced that those companies, however they're valued, are worth more today than they were last week, last year, 2 years ago? It makes you feel good because you're in a culture that believes in what we're doing. And I think economically, that's about as important as you can get it. Especially, look, you're working a $15 an hour job, you're working $18 an hour. You're trying to make sure that what you're doing can last so that you can get that house and pay the mortgage. But knowing that the overall economy, these different indicators that are out there are doing well. Yes, there are some negative signs, and of course, there are always people who are naysayers. Heck, I'm the biggest naysayer. I say it almost every week because I'm a cautious guy. But looking at the end of the year versus the end of last year, I can honestly say, are we better off today than we were last year? Yes, we are. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks very much for tuning in, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929 is our telephone number. If you want to write that phone number down, you're going to hear a great segment here. You're going to have a lot of different questions, but listen to the segment. Call us up, ask us some questions, and we certainly can help you by answering whether you need a certain type of mortgage, a better rate, a different approach to what you have. You have complex issues, but you think you have the deal that you want to buy, but you're not quite sure about the financing. All of this is what we do here on the show, as well as in Malibu Funding. Now, we have many different types of guests to come on the show, not just Malibu Funding guests, but our next guest from PMA. She's been on the show many times from Covina, runs her own mortgage shop, and I'm really pleased to have her back on the show is Connie Hernandez. Connie, how are you?
I'm fine, Jeff. How are you?
You know, I'm pretty well, thank you very much. I get a bit of an echo on your end, but we'll try to modulate. I'll have Daryl riding the board to make sure we don't have too much of the echo. But tell me what's happening. Two things. One, I understand the real estate market has gotten tighter, and two, the interest rates have remained low.
Well, it's been a little bit of a roller coaster with the interest rates, as you, I'm sure, are aware of. You know, last week we were improved rates, worsened rates, improved rates. So it's been kind of a bit of a roller coaster with the rates. We're fine if they just keep roller coastering. We just don't want them to continue going up, correct? Because there's still an awful lot of good opportunities out there for people. You know, it's interesting you asked me about the real estate side of it. You know, I have seen a little bit of a slowdown. It could be the holidays. I'm hoping it's the holidays, but a little bit of a slowdown on the real estate side. We're still busy on the mortgage side, thank God.
Yeah.
And even though a lot of us are on either holiday mode, vacation mode, or stressed out mode.
I think all of those, right.
All the above?
Yes, absolutely right.
But regardless, we're happy to take on new clients at any time. Our offices will be open except for the two important days that we take off. But other than that, we're happy to take in clients, answer their calls, walk them through different options that they may have. And, you know, I'm happy to also tell you that I started this program, really interesting program, briefly tell you a bit about it. But it's an amazing software system that if you go into a 30-year commitment, it actually guides you on how to be mortgage debt-free in less than 15 years with not a whole lot of extra money out of your pocket. Amazing tool. I'd love to share it for anyone who has any questions about it. I'm happy to share that information.
Oh, that's excellent. Now, anybody that wants to obviously own their own home outright, and I think most people do. They don't want to use it as a constant, cash machine. They'd rather have it either be that's what I'm going to have for my retirement, or this is what I'm going to, hand down to the next generation. So anything that you can do to help people move that process forward. I was just saying on a different segment, I did a 15-year fixed to get that done more quickly. So also, could you tell people where it is that you're located in the areas that you do service, just so we can tell people out there who may be new to the show?
Absolutely.
Great.
We're basically in the San Gabriel area, but in the city of downtown Covina, cute little town right on the corner of Citrus and Padillo. Been there for many years now, over 10 years. Been in the industry for 25 plus years. And you can reach us at 626-918-2419, Connie Hernandez. And I have a lot of enthusiastic loan officers that would love to take care of anybody who has needs in the area. We also do service, obviously, San Diego area and Inland Empire, but our focus mainly is the San Diego Valley area.
Okay, that's excellent. When you service your clients, obviously you're looking to give them the best service, but there are probably a lot of different choices now, especially in the non-QM world. And as I've been reading, the non-QM world is now about a third of the loans that we're doing in the mortgage marketplace, meaning that most of the loans still are being sold to Fannie and Freddie or FHA, but a great number of them are not. And what kind of loan programs are out there in that non-QM world which might help people who, quite frankly, can't get a loan through Fannie or Freddie?
Well, interesting you asked me that because, if you would have asked me the same question last year, it would have been a completely different answer.
Okay.
But we have had a huge amount of difference as far as volume of loans coming in that are non-QM loans. Most of these, I want to say, are 24 or 12-month bank statement programs.
Right.
There's quite a few options out there as far as lenders that we can address. I found a couple that are actually offering very aggressive rates for these types of programs. I'm actually in our pipeline right now. We probably have somewhere in the neighborhood of about 9 or 10 that are new, and maybe about 6 or 7 that are closing soon. They are a little bit more time-consuming because there's a P&L that have to be addressed, and they have to be updated to date. So that's always a little bit more time involved. But regardless, it's an amazing opportunity for those people that are self-employed, especially that, obviously have the ability to use tax deductions to offset their income, but sometimes that may hurt them to qualify for a traditional Fannie Freddie loan.
Right.
So that seems to be the trend right now, 24-month payment program. And believe it or not just people that are self-employed, meaning independent contractors are using. A lot of restaurant owners are using it. Some independents that I get the loan for an attorney. So they have contract work, and he works based on a 1099. So,
right.
The program fits all kinds of different professional backgrounds.
Now, in the cost on these loans, there's the cost and there's the rate. Is it differ a lot in this marketplace from, let's say, a conventional 30-year that you can see in terms of, the cost and the rate? These are the things that people always look at. And then obviously,
right.
So what's your opinion on that?
Well, surprisingly enough, the cost is I would say, for the program itself and for the benefits and the value of being able to purchase, it's not an exaggerated cost. Now, mind you, same question 3-4 years ago, yes, any non-QM program came with heavy costs.
Right.
But there's such a assertiveness out there to offer these types of programs. They're being very competitive as far as costs are concerned. And I've seen the rates drop significantly in the last year on these programs.
Yeah, so have I. And I think that half to 3/4 of a point different than what you might be getting, especially if you've got great credit score. I mean, that's always the mitigating circumstance, right? I mean, if you're a mid-700 FICO score, you're going to get the best program available.
Absolutely. And, I have not unique, I'm sure, but very seldom probably thought of to be a potential buyer. I myself am not heavily experienced in it, but I believe there may be a market out there. Recently, we closed an ITIN loan, and with one of the broker relationships that we have, the gentleman owns owned the restaurant for 5 years, has a strong deposit history in his bank accounts, his 24-month bank statement program. FICO score was well into close to the 800s.
Oh, wow.
And plenty of reserves, and he'd been in business many years, and the thing is, he never thought he could buy. Well, through this 24-month program, he was able to buy, and he bought a beautiful home, and he's very excited about it because he didn't really think he could buy.
Yeah, I think most people who are listening to the radio are thinking, I don't know. But you got to talk to somebody. And we were talking the differences between people trying to not talk to anybody and get a loan versus people that want to talk to somebody and get a loan. Always the expert in the field somebody that can help you, I guess, figure it out is really the way to go, because it's a very complex situation if you're new to it, and a lot of the jargon, a lot of the forms, a lot of the terms are just not easily understood. A program like you're talking about for this guy seems like a godsend, right? I mean, for a guy who didn't have a home, now he has a home?
Exactly. Successful in business, always wanted to own a home, and now he actually was able to close and move in, and he's ecstatic about it.
Excellent. Connie, thanks very much for coming back on the show once again. It's Connie Hernandez from PMA, and we'll talk to you soon. Thanks.
Thank you so much, Jeff.
Thank you very much. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's our telephone number here. Write down the number, listen to our great guest, and then call me with questions. Most of the things that we talk about on the show are trying to benefit you, the listener, in finding out or getting some information on a loan. You want a loan, you want to buy a house, or you want to do a refinance, or you want to do an investment property. There are all kinds of ways that you can get a loan, but you need to speak with experts in the field in order to get the best possible information. I always say to shop around, ask a lot of questions. So this resource, the show that we put on each and every week, The Mortgage Voice, is your easy way to tap into some of that great information from professionals in the field, not just me telling you. No, it's me having good people on the show each and every week who are willing to share. This next guest is no exception. Been on the show several times, many times. Tomas Trujillo. He's from Lone Stream, great company here in Southern California. Tomas, how are you?
Hey, Jeff, how are you? I'm doing great. How is everything with you?
Everything's pretty well. Thank you very much. Okay, explain to me what is happening with mortgage rates in this current market and how you're asking or getting your people to take advantage of what's going on.
Mortgage rates have been bouncing around this last week. I try not to play the mortgage rate game because they'll be up today, they'll be down tomorrow. I say never wait on a rate to get where you want to. It'll never.
Hey, Tomas, we're having some audio problems here. Are you on a headset or something? Something you might be able to switch out with just a handset?
Sure.
Oh, yeah, that's better.
A little better?
Oh, yeah, that's much better. So you were saying you don't play the rate game, so basically you're talking in terms of non-QM market. What are you looking at when you say something like that?
What I've been seeing lately, I've been doing a lot of non-QM DSCR loans, no ratio loans, where the borrower doesn't bring in any kind of income. I don't want to see taxes. I don't want to see pay stubs. I don't want to see anything. The property don't qualify on its own. Or I do a lot of DPA loans, where the rate is already set.
Okay. And those DPA are called down payment assistance, and the other ones is an investment property loan, correct?
Correct.
Okay. Explain that investment property one. I love that loan, and I think we need to push it out there more.
Well, if you're a home buyer right now and you want to buy a property and you don't want to show any income because you're writing it all off on your business, or you just don't want to show anything, what we would do is we would take the property that you want to buy as a non-owner, make sure we'll take the PITI against the rent it generates. If we're even or above, then you show me nothing. It's called a DSCR loan.
Okay.
If the rent doesn't cover the PITI, then we call that a no-ratio loan. The rate is a little bit higher, maybe an eighth higher, but you're still showing me nothing, and you're walking into the property with nothing, with about a 620 FICO.
What? So this is a non-owner occupied investment property loan that you can get into with a 620 FICO score, and what kind of down payment?
On something like this, you're probably looking around 80 LTV.
So 20% down, 620 FICO, investment property, and no income's required.
No income.
How do you prove out that you've got a renter? How do you do? Do you present a lease? Do you just say this is what it could get?
I'm not going to ask. There is no proof.
So this is a totally stated kind of program in terms of future revenue that you're going to get from the property.
Yes, the only kind of any kind of income I'm going to get from on this loan is going to be the appraiser is going to tell me what rents go for.
Okay,
that's it.
Wow, this is great. How successful has this been so far?
You know what? It's been pretty much bread and butter for me.
Wow, and
it's a great loan. Why wouldn't you want to get into it?
Why wouldn't you want to get into it? You're basically saying, okay, I can get into an investment property very, very simply. And this is all in Southern California, or is this nationwide?
This is nationwide.
So if you're out there right now and you're thinking to yourself, how am I going to have a long-term residual income? This is the way to do it. This is the market it's in. What kind of rates are we talking about, and fees perhaps?
Fees is a flat fee. We're not charging points. We're not doing any of that. It's a flat $12.95 underwriting fee.
Right.
And rates, I mean, they're going to vary depending on your FICO. If you're a 620 FICO, you'll probably be in the mid-sixes.
Okay.
If you're a 780, you'll probably be... Actually, I priced one this morning that was 4.875.
Okay, so your regular 30-year fixed Fannie Mae is 3.875, so it's a point higher, and there's no income involved. Right?
There's no 4506, no nothing.
And is this available to foreign investors as well? What's some of the other criteria?
No ITINs or no foreign nationals.
I see.
Other than that, you're good to go on it.
This is a very good loan. And these type of loans, do you see this type of product expanding? Do you see this as a short-term fix, or are you looking longer and maybe to broaden it a little?
This is a long-term product. This is going to be around for a while. We've had it now for about a year and a half, and now other lenders are starting to pop up with it. We see it just growing and growing.
Is it because the market itself is so tight that all real estate investments are going up in value, and so that if you're putting a 20% down, let's say, you're basically in a year or 2 years going to see 25, 26%, so that your investment is very secure? Nobody's going to walk away from that kind of equity?
Yeah, exactly. That's what we're seeing. And this loan is based on the old commercial loan, where it was kind of the same thing. You really didn't need income as long as the property paid for itself.
Right.
That's what they were concerned with. So that's why we call it a DSCR, a debt service coverage ratio loan.
Right. And you're saying, as a result, if it doesn't cover, you're going to just up the rate by an eighth or so?
Well, if it doesn't cover, we'll up it by an eighth. We still have at least 20% equity in the property.
Right.
And we're thinking that, if you're not going to let it go, it's still income producing. And if we have to take it back, it's going to pay for itself.
What kind of loan limits are you talking about here? How high do these loans go? $500,000, million?
Oh, no. We're talking up to $10 million. On a 700 FICO,
right,
you can go to $10 million.
Wow. That's really good.
Oh, yeah.
So, and do you have a limit in the number of properties someone could get into?
No.
So there's no limit. You could do 10, 15, 20 properties. The sky's the limit in terms of the amount, $10 million.
Yeah.
And, the equity that you bring to it is 20% on average.
That's it. We do a lot of investors. We do a lot of first-time investors. You have a borrower out there who has a home. They're looking to buy something. And like I said, they're business. They don't show any income because they write everything off. This is the program they get into. Or they have multiple properties and they don't want a hard money loan, or they want to get out of the hard money loan. This is what we do.
Excellent. Hey, Tomas, shout out your phone number for somebody. I know there's people right now thinking, how do I get a hold of this guy? I want to talk to him about it.
Oh, absolutely. They can either call you or they want to call me directly. It's 323-228-5181.
No, that's excellent. All right, give us your prognostication. We're here at the end of 2019, right? The year went fast. The market really changed for the better for us this year. What are you foreseeing in the near term, and then for most of 2020? Big year, 2020.
Big year for 2020. I'm thinking that it's going to be even a better year You see a lot more builders out there, a lot more building loans going on out there.
Right.
I think we're looking pretty good as far as our business is going.
Yeah, I agree with you, and I absolutely love the fact that we're seeing a lot of new homes built. I saw an 11% jump over last year this month, which is encouraging to me. It says that the big boys are saying we are in, the believe in the economy group, not in the naysayer group, which I think is great. That's what we need more of, more houses.
Absolutely. Especially here in California. Everybody wants to live here.
Everybody wants to live here, regardless of what people say about people leaving and going away in drones and businesses are leaving. Well, they might be, but the population keeps going up and they're building a lot of houses here.
Absolutely. California dream.
Tomas, thanks very much for coming on the show, explaining that terrific program. I'm going to push it a little bit more with my guys. Thanks very much for coming on again. This is Tomas Trujillo from Lone Stream. Thanks, Tomas.
Thank you, Jeff.
Thank you very much. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929 is our telephone number. Email address is info@malibufunding.net. Go to YouTube. We are on YouTube channel, Jeff Barton, the Mortgage Voice. You can see this and many other shows that we produce, and we have the Las Vegas real estate shows, some other deep shows in the archives. But we try to stay current. We try to stay up to what's happening in many different locations. One of the people that we rely on that is Gail Whiting from Capella Mortgage out in Las Vegas, Nevada. We love Las Vegas, love the market, but in talking off air, first off, Gail, how are you? Thanks for coming on the show.
I'm good.
Yeah.
How are you?
Like I say, I'm okay. I mean, business was down last month, and you were talking about naysayers, people who were just not sure about what's happening either in the economy or in the mortgage business. Expand on that a little, will you?
I think it was a little bit slow for us, too, but I think it's dragging a little bit behind. You know how that goes for us. The month prior, I recall hearing a lot of skepticism, which you know what that does to our market.
Yes, that's true.
About a recession. And I think, things are picking up again because the economic news is now, I don't know if anyone's talking about a recession.
All these economic indicators, and I am the first naysayer, and I'll jump on the radio and tell people and to beware. But this week, I'm kind of bullish on the whole thing. I'm just watching. Sure. I mean, the only thing entertaining more than the football games on Sunday is the impeachment hearings. I mean, it's like a football game. I want to get pom-poms. I want to, and I don't really care who wins or loses in this. And that's where I am because the economy is so good.
There you go. And I think the recession, if people pay attention, when most people were talking about the recession, the global recession.
That's true.
But, in the USA, as long as jobs are being created, people are confident to purchase, refinance, spend a little money. And so we need to bring it down out of a global look. And I don't think anyone was saying, well, I did hear a few, about a recession USA-wise.
Right. I think you have to look local always, whether it's in the U.S. proper or on your street or in your town or in your
street, town.
Yeah, in your town. I mean, Vegas is booming, in my opinion. I mean, I've been out there a lot this year. What I see is a lot of new construction, a lot of jobs, a lot of people who are, working and looking to buy. Real estate prices have really bounced. So, tell us a little bit about Capella, what you guys are doing, and how you're helping the different buyers that you do run into.
Well, Capella has a lot of different types of loans. We are a lender for hard money, do commercial.
Right.
Now, my particular expertise is not in the hard money. I'm sticking to the non-conforming loans, which self-employed, bank statement programs, things like that. I also do the conforming loans, your FHA conventional. So typically, I'm in conforming and non-conforming. Capella offers both of those, along with the hard money type lending. So some brokers are strictly your FHA conventional VA. Capella has, you could put it into three simple categories: hard money, non-conforming, and your conforming FHA conventional VA.
Now, have they raised the conforming limits in Las Vegas as well? I know they have out here in Southern California.
Oh, they've raised them.
Yeah.
Mm-hmm.
What are the conforming loan sizes out there, and why is that important?
Well, as the prices go up, FHA, Fannie Mae raise the loan limit allowed. As prices go up, incomes go up.
Right.
It's always reevaluated when there's a need for it. So now California seems to be about twice as high on the conforming limits than Nevada, but that's because it's, a different economy in California than it is Nevada. It's based on income.
I see it. It's an average income across the county, or is it average home price? It's income, right?
Yeah, income. Income is average income.
Okay.
Indicator.
Okay, what are the limits out there in terms of the conforming? Is it over 500,000? What are you guys dancing around?
No, and you would ask me that question.
You know what? I heard you're hesitating, and of course I put you on the spot. Don't think twice about it, because if you said, "Okay, Jeff, what is it in the Inland Empire?" I'd be hesitant to quote a number right now myself. So just to know that you have the best rates at conforming limits. That's what we're talking about here, right?
Yeah, and we do even have some lenders, because we're wholesale,
right?
Where we have a broader choice than banks do. A high conforming loan limit with near the interest rate of a conforming loan. So even if it does go over the conforming loan limits, we have lenders who do what we call high balance conforming.
Right.
And the rates are extremely similar, low, in the threes.
Wow.
Yes, for your better credit quality borrowers.
Now, what do you consider?
I'm not talking, bank statement programs. We're talking conforming, where you supply your tax returns,
of course,
pay stubs.
Right, and what kind of rates? Obviously, that kind of borrower, the person that gets a W-2 paycheck, has been working at a place for at least 2 years, is able to supply tax returns. These kind of people with, over 750 FICO scores are probably those golden borrowers that can pretty much dictate the lowest rates. Isn't that right?
Yeah, maybe not 750, but 700, 720.
Oh, okay.
Not too difficult to, with a little bit of work, if you need to get up there.
Right.
To get up there, we can work through that.
Well, I happen to think that the FICO score and how it's evolved is really because of the fact that non-QM loans are very close to the rates that the conforming loans are. I think FICO scores have almost become something that, okay, so you may get a half a point difference. But if it means you have to declare all your taxes and income, maybe you want to pay a little bit more so that you keep that information private. This is what I've heard from some borrowers out there. Do you hear things like that as well?
Oh, sure I do.
Right.
You're correct in that assumption that self-employed borrowers who have their business set up, to do things in a way, 0.5 is not a big deal.
Right.
If you have to change many other things when you're a self-employed borrower. So, yeah, they take the higher rate.
Right.
But that's not a penalty on a self-employed borrower. It's driven by the risk of the self-employed borrower.
And that risk, that's kind of what you assess as a loan officer there. That's kind of right in your wheelhouse in terms of both your experience as an underwriter and also as a loan officer, especially in a shop that boasts some, not only non-QM, but some hard money as well, right? Your assessment of risk is the job.
Is the job, yes.
Right.
And every lender has a different opinion on risk,
right.
Which is why you like to go to a broker, because just because one lender isn't necessarily willing to take on a certain risk of a borrower doesn't mean that we don't have a few more lenders that don't consider the risk the other lender thought was a risk its opinion. And that's why you go to brokers, to find the lender that best suits you as a borrower and your financial makeup.
Hey, Gail, we're at the end of our 10-minute little segment here. Sorry about that, but I want to have people have the opportunity to give you a call, especially if they're looking for an absolutely terrific person and loan officer in Las Vegas. Could you shout out your phone number for them?
Sure. My phone number is 702-503-3252. Again, it's 702-503-3252.
Thanks very much. That's Gail Whiting from Capella Mortgage. Thanks, Gail, for coming on the show.
You got it. Thanks, Jeff.
And thank you very much. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929, the telephone number. If you want to email me some questions, info@malibufunding.net or jeff@malibufunding.net. Either one of those will get to me ASAP. We have a Twitter handle at Jeff6493. I've got a blog, Barton blog. Although these two instruments I've really not attuned, but we're getting there. Recently, a reason being is that end of the year has been really busy. Have you found that, Daryl? End of the year?
Oh, it's been crazy.
Yeah. I don't know. Maybe it's me. Maybe it's the economy. Maybe it's just the stage of life we're in. But it's busy out there.
Yeah. Well, things wind quicker as you go forward.
Yeah.
I mean, no question about it.
That's absolutely true. So Daryl and I are laughing because we were, thinking about our childhood and some of the icons of my childhood. Whether it be entertainment or whether it be, in business, and how quickly things change. And so I was wondering, and I'll open it up to you, Daryl, too, given that, what changes that can you see, maybe foresee for the future coming up? Because it's 2020. I mean, this is a big milestone year.
Well, I mean, first of all, the on-ramp to the internet highway, or whatever you want to call it, obviously, is all the barriers have been taken down. I can't imagine 20 years ago or 30 years ago where these things didn't exist. We didn't have email. We didn't have internet.
Nothing.
And now, just boom. Bill Gates had said 30 years ago that everything that you need to know and everything that you own that's worthwhile can fit on something the size of your wallet. And it happened.
It's amazing to me, and I look at it like that simply because I know there are some in our listening audience who are in a similar age range, but there are a lot of younger people who just don't understand it, and not because they lack of anything or I put anybody down. It's just when you get to be our age, you have seen a lot. I know my father started when he was a kid. He was in 1912, right, when cars first came out. And he passed away shortly after the moon landing. So that spans a time and the things that change, the way things are changing now. So in the mortgage industry, for instance, what we've seen is a consolidation of information gathering and a move to put everything, obviously, as you're just saying, on the internet, in the cloud, wherever you see it, you're not going to be able to touch it anymore. It's going to be out there. You're going to be able to screen it. You're going to be able to look at it under multiple devices, but most of what you're going to be doing is now online, obviously. And in talking to a guy that I know who knows European security measures in a lot of the different EU countries, has said that the license, the passport, all documentation will be on your phone. There is no more paper passport, no more plastic license. Well, this is all going away.
Yeah, there are no boarding passes anymore.
None.
Really. No paper, at least.
Okay.
A little QR thing you scan.
Yeah, absolutely. And to be honest with you, I kind of like it. It's like going to the supermarket. Now, unfortunately, all these people are losing their jobs, but I like self-checkout. I'm one of these persons that's like, I am so sick of standing in line at places. If I can get in and out of there by doing it myself.
Well, they get into the obligatory conversation with you as they're checking out, like they know you, like they care personally what you're doing, and you don't know them from Jack.
Right.
And, just, add it up and let me pay you and get the hell out of here.
Well, I think because we're in this transition to this type of world, that you're finding that most people who are in the market for a home, who want to get a mortgage, who are trying to negotiate their way through something that is foreign to everybody, I don't care what age you are, just to do this, because of the nature of how this group of people likes to do things, it's much more difficult for them to pick up the phone and call a real estate agent or knock on a door or call somebody for a mortgage. They'd much rather do it without talking to anybody. And I think that's the push to get rid of a lot of the extra people in the business.
I think part of it is that they also don't want to be embarrassed or they don't want to be humiliated. And if you just punch it into a unknown entity like a computer, it doesn't insult you. It doesn't say, oh, that's all you make, I can't help you, or what have you been doing with your life up until now?
Right. Well, all that is true. And I agree that, the problem with technology for people who are not born into it, like you and I, is that we have, or I have frustrations with it because it either doesn't happen fast enough or user input. It's always user error. I do something wrong that I really don't know what I did wrong.
GEICO, garbage in, garbage out, right?
Exactly right. Okay, so let's get to the mortgage interest rates. We have had a pretty stable market in the last week to 10 days. The 30-year fixed rate loan is 3.875, which is still smoking rate, below 4%. The FHA VA rates 3.375 to 3.5%. And remember, in quoting these rates, this is an average of rates across the Southland. Sometimes they are on average across the country. And I get this, again, through our tremendous friends over at Mortgage News Daily, whether it's Matt or Jan Swanson or a number of the other. And another thing, in what Fannie Mae and Freddie Mac are doing right now, and a lot of changes are happening. They're trying to figure out how to get rid of that 30-year fixed rate mortgage. Now, why do I say that? Because if we get into a market whereby interest rates eventually go up, and that's one of the things that when the Fed was trying to unwind, or the Treasury unwind, both of them actually, their balance sheets, because for a long time what they called QE, and it is still happening, but not to the degree, they were buying treasuries and they were buying mortgage-backed securities. The Treasury was buying mortgage-backed securities and the Fed was buying treasuries. And so the government or quasi-government entities were buying up what was on the market for those entities in order to liquefy the market and make sure that there was enough mortgage loans and enough money in the Treasury to pay the bills. So it was kind of a cheat in artificially keeping the rates low. Yes, we all know that. So if, in fact, we get more to a normal level whereby the Fed isn't doing that anymore, the Treasury isn't doing that anymore, and the balance sheet, which is close to $4 trillion at the Fed, unwinds to a more normal rate. Let's say they cut it down by, that they had cut it down, by the way, by close to $500 billion. Now it's gone back up. So let's say we get down to a more normal rate, and these numbers are so huge I can't even really describe it to you. But if that happens, there will be a need to be able to make money by member banks and to be able to churn your particular loan more than once in a lifetime. Or if the rates go down and you need money out of your house, you do a cash out refi. But if most loans were 15 years at the longest, that would mean you would have to refi that house at least twice during your lifetime if you stayed in there the whole time. That's what is coming down the pike, in my opinion. And that's why I think that rates at a 15-year at 3.375 are smoking right now. And also, in the future, a 15-year rate will still be low because it's not a 30-year amortized loan. So you need to keep a rate low enough so that you can tack on your particular margin and you can be able to make enough money to make it worthwhile, especially if you're considering that you're going to churn that loan 2 or 3 times. Now, if that happens and during the life of your home you are doing 2 or 3 loans on that home, you're basically saying to the market, we're going to double and triple your business, because that's what's going to happen to the 50 million loans that are out there, as opposed to me, who got one loan at 15-year fixed, paid it off, and I haven't gotten a loan since. And that, too, is probably going to be something of the past. Anyway, I'm Jeff Barton. I really appreciate you listening to the show. If you have comments or anything you need to say, pick up the phone, give me a call, email me, however you want to get to it. And if you want, you can see the show on YouTube. Go to our YouTube channel, The Mortgage Voice, Jeff Barton, The Mortgage Voice, and you can see this and every other show that we've got going, and I really appreciate it. Anyway, I'm Jeff Barton, your voice in the mortgage industry, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.